time now for our Muni Moment, and today we're focusing on where you can find value in that space. Jennifer Johnston joining us right now, Director of Municipal Bond Research over at Franklin Templeton. And let's start off here, Jennifer, with I think what I thought was interesting, seeing a lot of demand out there right now by investors, even for some of the high yield stuff out there. And I am curious if that constitutes value in this market.
Thanks so much for having me. Yes, actually it does. We're finding value the longer out we go maturity-wise, and then the lower on the rating scale we go. We have a very detail-focused research staff who can go and find those special deals, even if they're in the high-yield market.
Is it just the yield that's being offered? I mean, we had some great stats on the Bloomberg terminal today, Jennifer, about basically anything with the interest payment above 5.5%. If you just took that and looked at issuance, we're something like double where we were through the same part of 2022 versus here in 2023 here. Is it just the yield that investors are being attracted to? Are there other concessions being made?
No, I think there are other things. I think, primarily a reason to be in this asset class is for the tax-exempt income, which if you pay taxes, munis probably can fit into your asset allocation in some way. So that's probably the primary way. Other advantages we see include the fact that as compared to our corporate counterparts, we tend to have lower default rates as well as generally higher credit quality. So you can have a little bit less risk and still earn after-tax value.
Jennifer, the big data point that's coming up in the next few days, of course, is CPI on Tuesday. And right now we are looking for an increase of 4.1% on the headline number. What is the impact of inflation on muni bonds?
Sure. There's actually positive and negative impacts on muni bonds. Of course, the obvious one is the cost of borrowing increases. And with this being such a capital-intensive asset class, that can impact issuers. Also, the cost of doing the projects is going up. Just like it costs us more to buy food and other goods, it costs municipalities more to run their governments. There is one positive impact, though. As prices go up, sales taxes, which are a major revenue source for many municipal credits, also goes up. Same thing as wages go up. We have a very strong labor market. As wages go up, so do income taxes. Again, another large source of revenue for many municipalities.
And one thing that you note as well is that a lot of state and local governments or agencies have to adopt budgets by the end of this month, by the end of June, because their fiscal year starts on July 1st. We know overall that the economy is slowing down, but what is the shape of this slowdown? How does it compare with estimates when you look at individual states and municipality budgets?
Sure. I think one thing to keep in mind when we look at budget season is that municipal credit is at, in many sectors, all-time highs. The post-pandemic recovery, combined with the significant amount of federal aid, have put many state and local governments in a very strong fiscal condition. So as we start to see prices rise, we start to see maybe some challenges with lower surpluses or lower revenue estimates. State and local governments are really in an excellent place right now to manage those challenges and be able to pass balanced budgets and still provide services for their residents.
There's still a lot of longer-term concerns here, Jennifer, particularly when it comes to some of the major cities. I mean, where I sit here in New York and even out west where you are there in some of those cities as well, about the health of those downtown districts, those central business districts here. And I'm wondering, is there a feed-through into the municipal space here, or are some of these municipalities able to sort of wall that off?
Sure. I think there's three things to keep in mind. First of all, this is going to be very regional, as you've pointed out. Some downtown areas are having challenges, whether other areas are doing really well and seeing tremendous growth. The second, we think about it in terms of direct impact, which means things like property taxes. Will the valuation of these buildings go down, and as a result, property tax revenues go down? And in this case, we, especially in some of these larger cities, we think that the tax base is is very diversified, and that the governments will probably be able to absorb the shifts in property tax revenues. What we are watching, however, is sort of the indirect aspects. What happens when businesses close because buildings are vacant? That's less income tax revenue, fewer people riding mass transit, and less sales taxes. So that's why we continue to watch many of these financial districts is to track that. But we still have a bit of a runway. The way that this process works, it's probably about 2 years until we're going to see, the real height of any challenges. So it gives local governments an opportunity and a little bit of a timeline to try and reinvigorate these areas.